Bell Direct now. And Tim, I'd like to get your thoughts on this story from Transurban Group, saying it won't be any cash impact from the transfer of that US toll road. What do you make of the news?
Yeah, well, this is always Transurban's disappointing asset. I mean, you look at their assets here in Australia, they've continued to perform pretty well, particularly the toll roads down in Melbourne, the City Links here in Sydney, the M2s, the M7s, etc. And it was that Pocahontas Highway in the US which had been the disappointing one. I mean, it was a bit of a gamble for the company moving over to the US and diversifying over there. As you mentioned in that intro there, some circumstances haven't eventuated, and we saw some big write-downs on this particular toll road. But I think overall this particular company, Transurban, it's that sort of defensive style business. It pays a good yield, but at these kinds of prices you see the stock at, investors do need to pay a bit of money to buy that dividend yield. It's never going to be an explosive growth type stock. We're seeing at the moment they're upgrading their M2, which is one of their major assets here in Sydney. That's expected to finish pretty soon, actually. So that will be a boost for the business. But you look at what this particular company's leveraged towards. It's very leveraged towards economic growth here, and also employment levels. Employment levels have a big impact on their volumes on their toll roads and how much they bring in revenues. Now, yesterday we saw some good figures, I suppose you could say good figures, in the unemployment rate falling to 5.5%, but only 1,100 jobs added, so that wasn't so good. So I would say, if we are going to expect unemployment to rise through the rest of the year, as many forecasts, that'll be a little bit of a dampener for Transurban. But it has been a bit of a steady performer. Again, looking a little bit expensive, but a good dividend yield.
In focus though, Toll Holdings really outperforming on the market yesterday. We've seen quite a few broker rating changes on this stock. What are your thoughts?
There's some very mixed views on this particular stock, Toll Holdings. We saw CIMBC come out this morning and raise it to outperform. Bank of America Merrill Lynch has it at underperform. Nomura has it at a buy. There's a few holds on it in the market. And yeah, it did buck the trend yesterday. Rose 2.8% on a pretty disappointing day on the broader market and for broader cyclical stocks. I think this particular company, the growth outlook looks a little bit challenging, a little bit hard in the short term. It's very leveraged towards domestic economic activity here. But that said, I think, it's traded back. It's lost around 22% or so in the past 3 months. So I think the stock price has really factored in the short-term difficulties that the company's facing. If you look across the company and its sectors that it operates in, its Australian transport division does make up the majority of its earnings, around 60% of group earnings. And within this business, you've got the express business. Now, that's very leveraged towards discretionary spending and discretionary retail. That makes up about 50% of that revenues in that particular business. And what we do know is discretionary spending and retailing has been fairly soft recently. Within its other businesses there, it's also very leveraged towards the resources and also industrial sectors of the economy, which has also been seeing some softness at the moment. While you look at the freight business, rail volumes have been trending lower recently. So in the short term, you can see the challenges this particular company's facing. But I think, as I said, I think the markets recognise this. The share price has pulled back. So it is very leveraged towards an uptick in Australian economic activity. May not pull through this year, 2013, but I think now might be a good time to start looking at this particular stock, because it will move ahead of a recovery in earnings and a recovery in economic conditions. So I think it looks pretty good over the medium term.
Just finally, Tim, what are you expecting at the open today? It looks like we are going to have about a 1% rise after yesterday's sharp sell-off in line with the rest of the Asian markets.
That's right. If we can get a 1% rise and hold on to it today, we'll avoid a fifth straight weekly loss for the Aussie market. We're down for 4 straight weeks. Week to date, at the moment, we're down 0.9%. Now, the SPI futures are indicating, a bit more than a 1% gain on the open. So if we can hold on to that, we'll avoid that fifth straight weekly loss, which we haven't actually seen since the GFC in 2008. So that wouldn't be a particularly good sign for the market. I can probably expect the materials to bounce back pretty well today. You look in London trade, BHP and Rio both saw pretty good gains. Iron ore trading came back online. We saw a small rise in the iron ore price, so that'll be a positive for the miners. Yesterday, we finally looked like we saw some yield support come in for the banks. They were the big outperformers on the market yesterday. And after the correction we've seen in the banks, the big 4 banks are now yielding on average around 6.1%. So that dividend yield's popped back up again. So we'll probably start to see some retail investors and superannuation investors domestically look to come back in and jump into the bank banks around these kinds of levels. Certainly some stability in the Aussie dollar would be a positive for the banks, because we know that that falling Aussie dollar has been a story that's driven offshore investors to sell out and take some profits on these high yield and bank stocks. But the Aussie dollar will be probably another focus on the market today. We saw a bit of a bounce back overnight. It's back up around that 96.5 cent US level. I think what we did see on the market yesterday was those players that were leveraged towards a higher Aussie dollar or a lower Aussie dollar, the underperformers. And I think we might see a bit of a continuation of that theme today. We might see the likes of News Corp, so maybe some of the healthcare stocks slightly underperform the broader market just due to that higher Aussie dollar.
All right, Tim Piper from Bell Direct, thanks so much for bringing us across